Depreciation expense is defined as the expense that's recognized as an asset is used to generate revenue. And it's based on the useful life of the asset. We'll do an example in a minute. But the question today is, what if the useful life changes? And specifically, what if the asset becomes obsolete? Well, accounting rules say if the asset becomes obsolete and it can't be used to generate revenue or not as much revenue, we need to reclass the value of the asset into an expense account. And this is particularly important right now because with AI, we have AI chip technology that is changing. And many of these chips, GPUs, and other equipment may become obsolete. And AI companies that are buying chips may have to write off millions or even billions of the value of the assets that they've bought in AI chips. So let's talk about the ground rules when it comes to depreciation expense. Regardless of the method you choose, at the end of the useful life, the entire value of the asset, assuming you don't write anything off, the entire value of the asset is transferred to expense. And we can use straight line depreciation, which I'll do in a minute, or we can use an accelerated method of depreciation, which recognizes more depreciation in the early years, less in the later years. Why do we even do this? The idea is to match the depreciation of the asset with the revenue that's generated from using the asset. So in some cases, we may use more of the asset in the early years and less in the later years. So let's use an example. Let's say you buy an AI chip. It costs you $50,000. It has a 10-year useful life, which means using straight line depreciation, you depreciate it $5,000 a year. So at the end of 2 years, the book value is $50,000 less $10,000 depreciation, accumulated depreciation equals $40,000. That is your book value, or the cost, $50,000 less all depreciation, accumulated depreciation, $10,000. So the book value's $40,000. And then let's say that the chip that's on your books as an asset is now obsolete. There's other chips that you need to use to be competitive in the AI space. It's no longer useful. In fact, something has come along that's even so much better that it doesn't make any economic sense to use this asset anymore. It's obsolete. At that point, you're going to write off $40,000, meaning that you're going to debit depreciation expense $40,000. You're going to credit or reduce the value of the asset by $40,000. If it was an accelerated method where we've recognized more depreciation than the straight line method that I just explained, obviously what we need to write off will be a smaller amount. But that's how useful life and obsolescence impact depreciation.